I'm going to talk about the Biden stimulus on today's video. Could it be good for the stock market? Now, there's a lot of debate about Joe Biden's administration stimulus. Some economists like Larry Summers and others think it's too big. Some think it's actually okay, like Paul Krugman and others. Now, what's interesting is the US economy has actually recovered surprisingly quickly from the coronavirus crisis. If we think back to 2008 and look at the US specifically, the US economy only contracted by 0.1% in 2008 because, if you remember right, Lehman collapsed near the end of 2008 and there was growth in the first 2/3 of the year. Then 2009, there was a contraction much bigger. I think it was like 3 or 4%. 2010, the economy went up, but it wasn't until 2011 that the economy got back, I believe, to where it was in 2008. So there was 3 years to get that recovery, and that was quite similar in many developed markets. Now, what's interesting this time is it seems like the US economy might well get back to its pre-COVID peak by March this month, or at least sometime this year, depending on how you measure the GDP numbers and what the final figures are. And what's quite interesting about that is that the economy fell much more quickly, much more fast after the initial COVID shock. However, it also came back more quickly because during 2008, the banking sector wasn't lending to people. People were paying back their debts. So it lagged for quite a long time, whereas COVID was a short, sharp hit, but then it came back much more quickly. We see that with the unemployment numbers as well. I mean, after COVID, US unemployment went to as high as 15-20%, which was much higher than during the global financial crisis, where it peaked at about 10%. But now it's down to, I think, about 6%, which is roughly where US employment was in about 2013, a whole 5 years after the global financial crisis. Now, some people would say, oh, well, unemployment is not measured in the correct way because it doesn't count people who stop looking for work or whatever, but that's always the case. That was the case in 2008 as well. So the recovery has been surprisingly quick, but there could be many reasons for that. The stimulus has been much bigger, the intervention was much quicker on the central bank side. Also, COVID was more like a hard stop and then you can restart the economy. But this has got people wondering about Biden's huge stimulus. A lot of people are saying that just like Trump stimulated the economy in 2017, 18, 19, why do you want to stimulate an economy which is already likely to do quite well in the next few years? Some people are saying this could overheat the economy, lead to high inflation and so on, because the economy is already doing well, there's already a lot of liquidity and so on. Some people are saying this could lead to bubbles in stocks and real estate and so on. Of course, there are so many variables at play that it's impossible to say, oh yes, for sure, stocks are going to go up or down because historically they've gone up or down on stimulus. Now, added to that, stocks do usually go up, right? 72% of years, I think the S&P 500 has been up, 28% of years it's been down. Over a 5-year period, it's like 87 or 86 to about 14. Over 10 years, 90% of the time the S&P is up, 10% is down. 20 years it's been almost 100%. So of course stocks usually go up. So if you look historically, stocks have done very well during stimulus periods, but they've done well in general. So it is hard to tell. What I would say though is this, is that with interest rates being so low and with not many alternatives for people to put their money in our assets, more people will buy stocks probably if they expect even slightly higher inflation than average, even 3%, 4%, 5% inflation. With that being said, if we start to see bond yields go up, interest rates go up even a little bit, there is a no alternative, TINA, which is the acronym, might stop being such a big issue. I can remember during 2018-19 when the US central bank increased interest rates to about 2.5%. Many people said, well, it's not a very high return, but for the first time since 2008, people can at least make inflation or slightly above inflation by putting their money in the bank. So if the central bank increases interest rates again to say 2.5%, 3% or something like that, that might finally affect the stock market for a few years. But again, nobody knows, and it's never good to time the stock market. Somebody's never going to beat stocks long term, probably putting their money in the bank. At least it's never happened during our lifetime or indeed ever. So like all my advice, I would just say buy now, hold long term, be diversified. If you look statistically and historically, a big stimulus is likely to be good for the stock market, but there are so many variables at play here. And we also have to remember that non-US stocks have been quite weak compared to US stocks for a number of years. And many economies are struggling more in the developed world than the US. So for example, the UK hasn't done that well since the crisis with COVID. Europe in general hasn't done as well as the US. It's only really the US and some developed Asian societies and some emerging markets that have came out of this relatively okay, albeit with more debt. So we also have to look at stocks outside of the US, and as I've said on previous videos, I think they're primed to actually do better, some of these markets, than US markets in the next few years. So the Japanese, the British, many other stock markets look undervalued compared to the US. But having said that, with all the things that are going on in the US, such as, you know, this stimulus package, the fact the US is a tried and tested market, all those variables mean that a lot of people still put their money, I think, in the US. And also it's tech heavy, and whatever you think about tech, we are moving into a technological future no matter what happens to the NASDAQ in the next year or two. So the fact that the US stock market, even the S&P 500, is quite tech heavy could also help it medium to long term. But what's interesting in the last few weeks, we have seen the German market and some of the markets that haven't done as well as the US recently do very well. We've also seen that with South Korea, Taiwan, China. Other markets that haven't done as well as the US recently do very well in the last year or so. So we could actually have a situation where for the next 5 years, the US stock market doesn't do as well as plenty of others. But I think that Biden stimulus won't help the stock market absolutely dramatically as much as some people think. I think it will help to a certain extent, but it certainly won't hinder the market. How can I help you? In two ways. First of all, are you an expat, a high net wealth individual, or just somebody who lives in a part of the world where it's difficult to get access to quality investment solutions? In which case, go onto my website on adamfayed.com and find out more. If you don't fit into any of those categories, then in which case there's a range of free material on my website, on this YouTube channel, and indeed on my Quora, where I get over 200 or have received over 231 million views in the last few years. And finally, if you want to actually read my thoughts in more detail, go onto Amazon and find my book on there.